with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. Coming up, we'll have half an hour of business news and analysis. On today's show, the U.S. Federal Reserve cut interest rates by 25 basis points. How will the market respond? And China's latest economic figures signal a steady recovery. What are the details? And now let's begin with our top story. The U.S. Federal Reserve has ended the year 2024 with another interest rate cut. The Federal Reserve has cut 0.25%, and this is the third consecutive rate cut after the 0.5% cut in September and another 0.25% cut in November. Meanwhile, the U.S. inflation in November ticked up to 2.7%. The Fed target is 2%. So what does the Federal Reserve interest rate cut mean for the U.S. economy, and how will the market respond to it? For more on this, join us on the line now are Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, Chen Jiahe, Chief Investment Officer at Novum Archi Technologies, and also Yan Liang, Professor of Economics, Willamette University. So, Yan, I will start with you. So what do you make of the U.S. Federal Reserve interest rate cut, timing and magnitude, and what's the market response?
Right. So this 25 basis point cut is very much within the expectation of the markets. And so nothing really surprising there. So again, the Fed is weighing, the two different mandates, right? One is looking at the general economic growth and especially the labor market. And then also looking at the inflation. So we do know that in November, inflation rate now actually had a slight increase to now 2.7% year on year. But still, the Feds believe that even with the 25 basis point cut, that still means that the Fed's policy is what they call meaningfully restrictive at this point. So to them, it is necessary for the cuts just because the data support such a move. That said, they are also toning down on the cuts for next year. So now the expectation is that 2025, instead of cutting 4 times, they probably only cut twice. Jerome Powell is pretty optimistic about the economy. He said that the U.S. is pretty much, avoid a hard landing. The growth projection is that the U.S. is probably going to grow 2.5% this year and 2.1% next year, which is, on par with, if not exceeding, the kinds of, sort of long-term growth trend. So in a way, the U.S. economy is doing fine. And so the rate cut is supported by this idea that inflation is going to continue to go down, to moderate. And also the economy is doing fine. It's not overheated. So the rate cut is very much justified at this point.
And what are the signals for the U.S. interest rate cut in the next year?
Right. So as I just mentioned, I think, the Fed is, again, calibrating the different factors. And they believe at this point probably will be having 2 cuts instead of 4, as they earlier in September, they projected. That said, I think, again, there's so much uncertainty right now in the U.S. economy with, Trump in the office by January 20th. There's a lot of uncertainties when it comes to, some of his policy pledges, right? The tariff hikes, deportation of immigrants, and all of this, and also tax cuts. And all of this could, in some ways, increase inflationary pressure of the economy. And also, some of his deregulation and tax cut policies may help to fuel even more growth. And in other words, there might be more potential for the economy to be overheated and inflationary than the other way around. So I think, the Fed has been talking about they're looking at the data, just really using data to support their interest rate policies. And so I think it remains to be seen if Trump goes into office and really push forward policies as he pledges. It is likely. I think there are a lot of estimates. For example, Goldman Sachs has estimated if, without the Trump policy, inflation is probably come down, the core PCE inflation, that is, it's probably come down to 2.1% by the end of 2025. But with Trump's various policy, that could push inflation rate up to 2.4%. So, there's still a lot of uncertainties about Trump's policies. And so I think Fed would have to watch for the data to decide on their rate cuts or, stay put.
So, Professor Chu Qiang, so the U.S. interest rate cut may ease some of the concerns, but what do you think the risks remain for the U.S. economy? The U.S. national debt is now more than 36 trillion U.S. dollars. So, what issue is this creating, do you think?
Well, I think you mentioned the key point in here. I think the major risk here and the whole market, what they're worrying about, let's just take a look at the slump of the stock market. I think is people are worrying about, the whole market is worrying about the stagflation. This is very simple. You just take a look at the 36 trillion US dollar of the debt. This is probably the highest, in the human history. When it pile up that high, people will worry about how I'm going to repay that. And lowering their interest rate is basically just a start. But what's the reason behind that? And I think according to the comment of the Chairman Powell, I think he mentioned one thing is that the labor market is basically very stable and sound, and basically not the source of the inflation, but it's not cooling down to the extent that we want it to be. So basically what he means is very, very clearly, that is, the market, the civil society is not the problem of the inflation. If the market, if the customers are not the problem for the inflation and they're still trying to produce things, and who is the problem? So I think the answer is really clear. The government of the United States. The United States, while we take a look at the employment numbers, the latest employment numbers shows really, really good in the past 1 year. But if you break down into those chart of employment, you will find out that there are 800,000 of the newly increased jobs are actually been hired by the government. So which means the government of the United States want to make the number good. So they immediately they hired about nearly 1 million people just to work for the government. But by doing what? And also producing what? Maybe nobody knows. I think that's the reason why Elon Musk and Trump want to have this Department of the Government Efficiency, so that they can cut off or let go many of these job in vain, so that they can streamline the United States government and also save lots of budget and cool down the budget spending speed of the United States government. So I think this is not an easy job. But stagflation is not await people. Stagflation will just come to the market very, very soon. So I think that's the real problem that everybody's worrying about.
So, Jiahe, so talking about the bigger picture, what do you think the rate cut is going to mean for the stock market, housing, and especially for the U.S. consumers?
Well, when we look at the impact of this recent rate cut to the stock market, it's actually worrying about what's coming. It's not that the rate cut itself is actually pushing down the market, because with the financial theory, you get lower interest rates, people will get more attractive to the stock market. But what's going on is that the market seems to worry that, okay, the economy is not very good, so the Fed is cutting the rate. So we are worrying about the economic situation. They are not worrying about the lower interest rates. They are worrying about what's represented by this lower interest rates. That's the weak economy. For the housing market, but the rate cut alone would be a pretty good thing. I mean, people get lower mortgage rates, stuff like that. But if you look at the mortgage rate right now in the United States and the total interest rate, it is still a very high number. I mean, it's still standing at 4 or 5%. But if you look at China, currently our mortgage rate is dropping around 3% or even lower than 3%. I heard some banks can give you like 2.8 or 2.9%. So if you talk about a mortgage that will be lasting for like 30 years, that's a very large amount of money. The monthly payment will be very different if you get a 3% interest rate or if you get a 5% interest rate. And for consumers, is that, well, the lower interest rate brings, theoretically will bring more people to consume. So that's probably a good thing.
So, Yan, so you are a consumer. So what's the interest rate cut going to mean for the U.S. consumers?
Well, I think interest rate cuts for consumers, in a way, I think it's a good thing because, interest payment has been really high for U.S. consumers when the Fed raised the interest rate by 500 basis points in the past, a year and a half. So I think, with lower interest rates, it's actually helping the consumers because they're going to pay less on their mortgages. The US 30-year mortgage rate right now is about 6.8%. It's actually increasing despite the rate cuts. And again, the reason is because of some of the expectations about Trump's office is going to increase deficit spending, and so that's going to push the rates higher. So I think, with these large mortgage payments and, card loans, credit card payments with the high interest rates, in that sense, I think when you lower the interest rate, it's actually be more helpful for the consumers. Now, that said, of course, there are worries that interest rate cuts are going to make inflation worse. But I think, it's more nuanced than that. When you look at what really drives inflation in the United States right now, one is the owner equivalent rent, and also used cars, and some, food items like, aviation fuels, and then egg price actually has jumped up by 50% in November, after it fell by, 20% in October. So it's very kind of volatile. But when you look at, again, what drives inflation, it's not really something that interest rate hikes are going to help to reduce. So the equivalent, rent, that is a very large item in the CPI consumer baskets. And when you reduce the interest rate, it's not like people are borrowing to rent a house. So if you hike the interest rate, it doesn't mean that people are going to rent less, right? This is really a demand that people cannot avoid having. So what I'm trying to say here is that interest rate hikes, it's not necessarily helping to bring down inflation in the United States, because it's not going to help you to reduce your rental payments. It's not going to help to reduce the used car prices. It's not going to help to reduce the food prices. So I think in that sense, cutting interest rate, it's helping with the interest payment on the households, and so that it's helpful. And cutting interest rate is unlikely to, fuel more inflation, in my opinion. So I think overall, interest rate cuts would be a good thing for the economy, especially for the consumers. But again, I think this is a fine balance between how you stimulate the economy without, generating some kind of financial bubbles. I think that, to me, is more of the worry than the government debt. When you look at the crypto space, it has rising, really significantly, and we see a lot of increase in leverages. I think MicroStrategy has took on, over billions of dollars of leverage to buy cryptos. And we hear many stories like that. And so I think Financial Times has just published a series of papers about the mothers of all bubbles, as the title suggests. So I think the kinds of speculative mania, in my view, it's more of the concern as a result of the interest rate cuts and credit cheaper. So, investors, speculators borrow more on the margin to speculate in the financial markets, in the crypto space, in tech stocks. I think, to me, that is more of the worrying sign than the sort of the real economy.
And Professor Qu Qiang, actually, some say that the big tech drives the U.S. economy, and the average citizens often miss out on the benefits. So, what's your assessment?
Yes, actually, if you take a look at the market, basically the Magnificent Seven is the major drive of the market rise in the past half a year or even 1 year. If you take a look at the Russell 2000, that index, you will find out that most of the SMEs in the United States of America is basically just, barely floating, just to try to keep their head above water. Many of the small companies that actually their cash flow are not that good, but I think they still have some, deposit derived from the COVID period of time, because the United States government really give them a lot of the help and the relief, so they still got some cash on their bank account. That's the reason why they can still keep on floating. But I think with a high interest rate environment, many of these SMEs actually can barely afford to borrow new loans to keep their business running, especially when they try to expand their employment, or try to expand their out branches, and etc. So it becomes very, very difficult for under such a high rate environment. And that is a problem for it. And also, I think another problem for the United States of America is if you take a look at the statement by Chairman Powell, And what he means basically, while translating into English is, okay, we think the inflation is not going to go that quickly next year, even though we're confident about the job market, about the economic growth, but we're not very confident about the inflation. That's the reason why we probably is going to slow down the horse of the reducing the interest rate, which means maybe next year, instead of lowering the interest rate to around 3.4 percent, probably the interest rate will be around 3.9%, and less of the interest rate cut and a higher central interest rate, which means a stronger dollar and a continuing very high interest rate environment. Let's face it, 4% is still very, very high. Not so much of the difference from 4.25, right? So I think next year, if this high rate environment continues, most of the SME will keep on being stifled, and their environment of living will get tougher and tougher. And that's the reason why I mentioned about stagflation to come next year in the first place.
Mm-hmm. And so, Jiahe, so for the U.S. interest rate cut, what does it mean for the international capital flow?
Well, basically, I'm investing in China, so I'm more aware about what the interest rate cut will mean for the China's equity market. But if you look at the European market and Japanese market, they basically follow the market of the US. So this interest rate cut, because their interest rate is also quite connected with what the Fed is giving. As you can see, that if the Fed cuts the interest rate, in many cases, the European Central Bank just follows, and the stock market follows as well. So when the US market has been dropping, we are also worrying about what's going on with European stock market and Japanese stock markets. But for China's stock market, that's a different story, because it's been a pretty long while that people try to pick the market between the US and China, because in many cases, if you talk to global investors, they put the European market, Japanese market, and the United States market in one basket and saying, okay, they are following each other, but they put Chinese market, an Asian market, for example, South Asian markets, into another basket as an offset to what's going on with the US. So when you see the US market is actually falling, there will be capital outflowing from the United States, and they try to find some kind of harbor to safeguard their capital. And China's market is on the list. I mean, especially if you look at Hong Kong market, also the A-share market, because currently we've got this Shanghai and Shenzhen and Hong Kong connection program that you can easily invest your money into A-share as well. So you can see that the money, in many cases, you see a dropping of the U.S. market. So the fund can flow from the United States to China. Another thing is that overall speaking, for global markets, the dropping of interest rate will be good for the high dividend yield companies, because you have a lower interest rate, you have lower fixed income return. And if you look at stocks, you say, okay, previously I wanted a 6% dividend yield, or maybe I want 7%, but now with the lower interest rates, then 4% will satisfy me. And that means about 50% increasing for the stock price. So overall speaking, that's pretty good for the high dividend yield companies.
Professor Xu Qiang, so what does it mean for other countries around the world, especially those emerging markets and developing countries?
The stronger dollar means the situation that we have experienced in the past 1 year will be repeated again. A strong dollar means more of the money is going to still stay in America. And even when in the emerging market, when their assets price keep on get looming, and when their businesses and the small businesses and the national GDP are growing sluggishly, and I think still there are going to be many countries capital will flow back into the United States. So the asset price will face pressure, business operation will face pressure, and the local currencies will get depreciated further or continue to zigzag in a very weak position. So all in all, we're going to say this is still going to be another tough year if the United States of America's interest rate environment cannot get improved. Trade angle, you will see, because the United States is going to face stagflation, a weaker economy. So probably the import will, as a major buyer of the international product, I think imports into the United States will also get less or get weak.
Well, we're speaking with Chen Jiahe, Chief Investment Officer at Novum Archi Technologies, Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, and also Yan Liang, Professor of Economics, Willamette University. And after a short break, key economic indicators show a steady recovery in China. Stay with us.
Welcome. I'm Elaf Elad, economics professor and member of the Data Science and AI Center at New York University, Shanghai. On the World Today program, you can find in-depth and impartial insight, as well as critical commentary on key trends in the Chinese economy, financial technology, business, and blockchain. To prepare for the world tomorrow, join me on World Today.
You're listening to Biz Today. I'm Zhao Yang in Beijing. China's key economic indicators for November and the first 11 months of this year show a steady recovery. Retail sales of consumer goods increased by 3% in November from the previous year, and value-added industrial output grew by 5.4%. Meanwhile, in November, the decline in the prices of residential homes in China narrowed on a yearly basis. So, actually, China's industrial output grew by 5.4% in November year on year, with big contributions from the equipment manufacturing and high-tech sectors. So, what does it say about China's economy?
Right. So I think China continues to be this industrial powerhouse. You're right. The output growth by the industrial sector is 5.4% as of November. So that just shows that, the manufacturing sector, the industrial production sector continue to expand in a, really fast pace. But more importantly, I think we're seeing the kinds of upgrading in the industrial production. The value added and tech, content has been improving. So, out of the industrial products, we see the NEVs, the industrial robots, and integrated circuits have grew by 51%, 29%, and 8.7% respectively. So what that means is that, China is, moving up in that value chain, and really the advanced manufacturing sector is really outpacing the rest of the industrial production. So I think that's a very important, sort of a positive driving force for the Chinese economy going forward.
And Professor Qu Qiang, how do you think can China balance its industrial growth with the consumer demand to ensure the stable economic expansion?
Well, I think the continuous expansion of the consumption, based on two things. Number one is the stable income, the cash flow to the family and to the enterprises. How much money you can earn continuously, decided how much money you can spend in the future. That's a simple equation, right? And also, I think is the confidence and expectation. If you have the confidence and expectation for the future that it can always get a stable job, get a stable orders, and then you are going to be very, much convinced to spend your money in the long term and even plan for some further borrowing. And I think this is the basic truth. So China want to really achieve the sustainability in this kind of area for the consumption. That's the reason why I think Chinese government focused on job creation, focused on the supporting the industries, supporting the SMEs, so that they can hire more people. They can put the wage and salary into the pocket of people, and also when the enterprises, when the whole market is stabilized, the people will have a very stable expectation for the future. So I think that's the reason why Chinese government makes sure that the first package of the policies we're going to support the industry, the market, and the enterprises, and then when everything has been stabilized in job, in the salary, and also the consumption will catch up. And then the second round of the policy goes to the shopping coupons and supporting the trading policies, and as well as to support the export and import policies. So I think this is the order that Chinese government are looking into.
And Jiahe, so look at some of the measures that China has rolled out. For instance, in March, China unveiled an action plan to advance the large-scale equipment upgrades and the consumer goods trade-ins. And this is one way to boost the consumption. How do you look at these measures, and what impact do they have?
Well, China definitely has thrown in a lot of measures in order to boost the consumption. For example, upgrading the equipment, the old for new program, giving out coupons, which Shanghai has recently just give out another round of consumption coupon, that with the coupon you can reduce the amount of money that you are going to consume, like you spend 300 and cuts like 80 for you, and also cutting the direct taxation of consumption components and stuff like that. So all these things definitely help the growing of the consumption economy for China, and they brought a very direct help that the consumption has been able to grow at a pretty good pace this year. Also, China has conducted many other measures that is not aiming at the short-term improvement of consumption, but rather they are aiming at the longer-term consumption capability and willingness of consumers. For example, we kept on improving the pension for retirement people. We kept on reducing the medical cost, which China has been doing tremendously in the past many years. The cost for taking a pension to hospital is significantly reduced compared with 10 years ago. So all these measures reduce people's worrying about their retirement, reduces people's worrying about how much money they will have to cost if they get sick. So, which means you don't have to save that much for your tomorrow. So in that case, people will be more willing to consume. Also, there is another very significant thing is that the property market is currently being lifted by China's government in the past few months because of many policies given out. So with the property market, you can see there is a large amount of consumption related to the property sector. For example, you buy a house, you get so huge amount of things into your new house. It's not that you just buy a concrete box and leave it there. So it's a lot of things like furniture, air conditioner, TV set, sofa, all sorts of things you're going to buy. Some people even buy a new car because they bought a home that is a few kilometers farther away from their working place, so they buy a new car as well. So you see all these things actually happen. So if the property market is stabilized, then that also stimulates a lot of consumption.
Well, we're speaking with Chen Jiahe, Chief Investment Officer at Novem Archi Technologies, Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, and also Yan Liang, Professor of Economics, Willamette University. And that's all the time we have for this edition of Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.